So, like I said, today we're going to be talking about what is tax planning and why your business should be doing tax planning. So, getting right into it, there's two different types of accounting that you can get when you go to a business accountant. It could be tax preparation and it could be tax planning. So just looking very high level at the definition of each. So what is tax preparation? It's defined as the process of preparing and filing income tax returns. Pretty straightforward. That's what most business owners are used to getting. Between January and April every year, they go meet with their accountant, they give them their documents, give them their financials, their taxes are prepared and filed, they sign and pay, and boom, the engagement's done right there. So looking at tax planning, that's defined as developing a plan that minimizes how much you pay in taxes. That sounds a lot better because you're not just coming in, dropping off documents or meeting with your accountant once a year. You're actually being proactive and creating a plan to minimize how much you're paying in taxes. So two totally different services being offered there. So focusing back on tax preparation, this is a seasonal event, meaning you do it once every year, usually between January and April, or if you're filing as a corporation, the deadline is March instead of April. But this is a seasonal event, and it only happens once a year. Now, you're also just reporting the history of what happened. You're not doing anything proactive. You're not forecasting. You're just really giving your documents, reporting the history of what happened last year, and paying your taxes due. And the downside of tax preparation is this is the easy way out, but it also results in you paying the highest possible tax liability, which is a huge, huge downside, especially as a business owner. One of your business's biggest expenses is typically the taxes. So looking at tax planning, this is a year-round event. So at the very, very least, you should be meeting with your accountant twice a year, so every 6 months. Typically, we recommend even more frequently than that. Every 90 days seems to be a really good sweet spot for some of the larger companies, maybe even on a monthly basis. But you should really think of meeting with your accountant, let's just say on a quarterly basis every 90 days as your financial health checkup. So when you're making your budget and your forecast in the beginning of the year, you're going to put together your proactive tax plan at the beginning of the year. But 90 days later, you want to track, hey, is my business still on track for what we forecasted, or did we grow even more than we expected? Are we actually shrinking? Are we just maintaining? And all of those factors, did you make any large purchases? Did you hire any new people? All of these go into your tax plan, all of these factors, and your accountant should be aware of all these things as they're happening, or at least checking in on a quarterly basis to get an idea of what's going on in your business, and then also adjust your tax plan if necessary to make sure that you're still paying the least amount of taxes possible. Now, tax planning is the process of developing and implementing a proactive and strategic tax plan with the idea of lowering this tax liability. So when you look at tax preparation, think of high tax liability. When you think of tax planning, think of low tax liability. So what is the first part of tax planning? Well, the first thing that any accountant should be doing is ensuring that the business owner has chosen the proper business entity type. So looking at the three most common types here, we have a sole proprietorship, a limited liability corporation or an LLC, and an S corporation. So starting on the left side with the sole proprietorship, this is where most business owners start, being that you don't even need to actually go and form a business. This just means that you're self-employed, you are doing a service and getting paid for it, and you don't have a proper business formed. Now, you can actually go to your state and form a sole proprietorship, but even if you're just operating as your own name, John Smith, self-employed, then you are automatically classified as a sole proprietorship. So what are the pros of this? It's simple and inexpensive. You literally don't even need to formally go form a sole proprietorship. You automatically are one. And there's no ongoing corporate compliance. Now, what are the cons of a sole proprietorship? There's no liability protection and there's no tax benefits. It's just you are operating as someone who is self-employed or a business owner. And that's really the beginning and the end of a sole proprietorship. Now, looking at the LLC, which is what most people are familiar with, the pros of an LLC is that it's easy to maintain. You just have to go ahead, hire someone to form the business for you, form the LLC for you, and then you have an annual report once a year that you have to file and pay for. And the other pro of the LLC is that it comes with personal liability protection. So this is protecting your personal assets from your business, which the sole proprietorship does not provide. So what are the cons of an LLC? There's an annual cost to remain in compliance. This cost depends on your state. Here in New Jersey, it's around $100 a year. And another con, which is a huge misconception, is that there is actually no tax benefits to an LLC. This is strictly just to separate your business from your personal assets and create that additional layer of liability protection. That is the main benefit of an LLC. So moving on to an S corporation. What are the pros? And you can see bolded and in all capitals here is the S corporation. What separates it from these other two entity types is that this is a tax advantage entity, meaning that you can actually get tax savings from being an S corporation. And in addition to that, you also do still get the personal liability protection that comes along with the LLC. So the question that I get a lot when I teach people this is, well, why doesn't everyone just become an S corporation? Well, there are some downsides to an S corporation. There is an annual cost to remain in compliance, similar to the LLC, but there's also additional rules and regulations. And one of them, you can see I put it down here, is that as an S corporation, you're required to take a reasonable compensation via payroll. So when you're a sole proprietor or an LLC, you don't need to pay yourself through payroll. You don't need to pay yourself a W-2 income. You can just write yourself a check or make an electronic transfer, and you just pay yourself as a distribution. But when you're an S corporation, you're required to pay yourself in two different ways: through payroll as a W-2 employee, and then you can take additional compensation through distributions as if you were a sole proprietorship in an LLC. And this is just one of the additional rules and regulations that comes along with an S corporation. You also then have to file a separate corporate tax return at this point, an 1120S. So there's additional costs to be an S corporation. So you want to make sure that the tax savings provided by the S corporation outweigh the cost of becoming one. And that's the most important factor to consider. So for most businesses starting out, we recommend that you start as an LLC. And then eventually, as your business becomes successful and more profitable, you can eventually graduate to an S corporation. So to help you understand a little bit more about how an S corporation actually produces those tax savings, this is a nice little image to describe it. So on the left side here, we'll start out on the very most basic level. So this is someone who is an employee. And I know most people who are watching this are probably business owners, or they're not an employee anymore, but this is just to drive home the point. So when you're an employee and you receive W-2 income throughout the year, you are subject to payroll taxes. And these payroll taxes, what most people don't know is you're actually splitting this with your employer. So you're required to pay 15.3% in payroll taxes, but as an employee, you pay half, so 7.65%, and your employer is actually responsible for paying the other half of the payroll taxes, so the additional 7.65%. So when you are self-employed, you're both the employee and the employer, so you are responsible for the entire 15.3%. So if we go back to the previous slide, so when you're a sole proprietorship or an LLC, you are paying the entire payroll tax burden on the profits of your company, which is 15.3%. Now, when you're an S corporation, if you remember how I said before, you pay yourself two different ways. The first is through payroll and the second is through distributions. So you can actually mitigate the self-employment tax on a portion of your income. So on part of your income, you will be paying the full 15.3%, but on the additional compensation that you're taking, you actually pay no payroll taxes at all. So that reduces it to 0%, meaning that you're saving 15.3% on your additional compensation, which can really add up to tens of thousands of dollars very quickly. Now, looking at some other additional more advanced tax saving strategies, one of them that we really like to implement is called the Section 179 business vehicle deduction. Now, you may have heard about this. It allows you to deduct 100% of the business use percentage of your vehicle in the year that it's purchased and put in service. So to give you a great example here, let's say you purchased a vehicle for $80,000 and it will be used 80% of the time for business. So we take that $80,000, multiply it by the 80% of business usage. That leaves us with $64,000. And we're able to take a tax deduction in the year that you purchased the vehicle and place it in service for $64,000. So if you made, let's just say $100,000 that year, you can take $64,000 right off the top as a tax deduction. So that's really going to be able to lower your taxable income and lower a lot of the taxes that you're paying. So obviously there are some rules and regulations that go along with this. Number one, your vehicle must exceed 6,000 pounds gross vehicle weight. So this is usually large trucks or SUVs. The vehicle must be used at least 50% business usage, and you're limited to $1,050,000 per year. So no purchasing multi-million-dollar Bugattis. You're going to have to purchase a vehicle that's actually for business use. Another great rule that we really love is called the Augusta rule, and this one's a little bit less known than the Section 179. So the Augusta rule allows homeowners to rent out their home for up to 14 days per year without needing to report the rental income. So essentially renting your personal home to your business up to 14 days per year, your business gets a deduction for that amount, and you personally do not have to claim that rental income as income. So to give you an example, you're a business owner and you want to host a monthly board of directors meeting at your home. In exchange, your business has agreed to pay you $1,000 per meeting to rent your home. So at the end of the year, your business claims a $12,000 deduction and you do not have to report the rental income. So what are the rules and regulations that go along with this rule? So the rent amount must be reasonable, meaning that if your home reasonably rents for $1,000 per day, you cannot rent it to yourself for $10,000 per day because that is not reasonable. You must also own or rent a business location separate from your home, and the business conducted must also be documented. Now, what are some other advanced tax strategies? I'd love to keep going, into in-depth examples, but we would be here for hours. There are dozens and dozens of advanced tax strategies that can be evaluated, but just highlighting on some of the really key strategies that we see implemented very frequently. Tax advantaged retirement contributions. This is evaluating contributions to a traditional IRA, a solo 401k, SEP IRA. There's tons of other accounts too. Another option is an accountable plan. This is could be in place of the Augusta rule. This is allowing you to reimburse yourself as an employee of your business for personal expenses that are business related. There's also hiring children under 18, a 529 college savings plan, and health savings account optimization. There's tons of other strategies, but these are some of the most common that we see. So what does an example tax plan look like? So in this example, we took a business owner who makes $150,000 annually net profit, and we implemented just the three strategies that we talked about today. And like I said, there's dozens. The plans can get way more complex than this, but let's just look at a very, very simple tax plan for someone who makes $150,000. So we're going to say that during the tax year, they purchased a vehicle over 6,000 pounds for $50,000. And we're going to be implementing the Section 179 vehicle deduction to take the deduction for the full amount of that vehicle this year, which would produce roughly $15,000 in tax savings. We're going to be implementing the Augusta rule, saying that a reasonable rent for them is $500 per meeting at their home, and they're going to be taking advantage of the maximum amount of 14 meetings per year, which would produce roughly $2,100 in tax savings. And we're going to be converting them from an LLC to an S corporation. They're ready to graduate to that next level and receive the tax advantages that come along with that. And that will be saving them roughly $7,600. So in total, just by implementing these three strategies through their tax plan, we were able to save $24,700 off their taxes this year. And the best part about these strategies is that most of them are recurring. So unless you're buying another vehicle next year, you won't be getting the Section 179. But the Augusta rule is recurring every single year. The S corporation tax savings are recurring every single year. So you're saving $24,700 this year, and moving forward, you're saving almost $10,000 a year off these other plans that you're going to continue to run year over year. So you can see how quickly those tax savings really add up.